Hi friends, welcome to ABC Learning Solutions. In this particular discussion, we would like to talk about the share-based payments, for example, to employees, and when under these share-based payments, there is a modification in the terms of the options to be granted to employees as one of the examples. Think of it like this, that you are an organization and you offer to your employees, so let's say there are 100 employees. You expect them to stay with the organization for 4 years, and they shall have an option to buy shares after this 4 years, the vesting period, at, let's say $100 per share. Okay. Now, what you see is that initially, when you gave this option, the share price was sitting at $40, and you assume that the share price would really increase considerably. Let's say it would reach probably, let's say, $120 or $140 kind of a range. Okay. So when it reaches this range, so naturally they would be incentivized with respect to having an ability, having an option to purchase these shares at $100 per share. Okay. And let's say each employee is offered 10,000 options here. Okay. Essentially, even if it goes to a range of 120 as a minimum price, so each employee would get 120 minus 100 and then 10,000, and that makes $200,000 of value. Right. Of course, post completion of 4 years. But then think over it like this. Let us say around or at or sooner, as in around the end of the 4th year, at the end of the 4th year, sooner after this option is given, you have a reason to believe that the share price would stay below $100 once these 4 years are complete. Okay. That simply means what? That simply means that there is no incentive now for the employees to continue with the organization. Right. So what you can do is, as an organization, you may decide to do a modification in your initial plan, where you may say that maybe at year 2 you change the value of these, exercising the option at, let's say, $60 per share. Right? Because you also believe that people would not be able to exercise the option. The option simply goes out of the money. Right? So at the year 2, you rather decide to offer these shares at $60, and maybe the share price would stay somewhere between 80 to 100. So again, you bring the position even back to the employees here. Okay. So this is one example of a modification. All right. There could be another example of a modification where you say that instead of 4 years, you tell them that you complete 3 years now. Okay. So the change happens in the terms of the option there. Right. So basically, what we are trying to say here is that there could be such examples of the modifications which can arise after that option was given to the employees. It could even mean, for example, let's say instead of 10,000 options, after 4 years, you offer them 15,000 options. Right? So these are all examples of modifications, right? And frankly speaking, let's say, if I tell the employees now, after 2 years are gone, that the option can only be exercised at 140 instead of $100. Now this is a disincentive. This is going against the employees. If I'm telling them instead of 4 years, it should be rather 8 years or maybe 10 years. Now this is against the employees as well, right? But then these are all the examples of modification, right? Effectively, what my standard suggests, what my standard requires is that at any point in time, when you have given an option to the employee, right, such kind of options to the employees, necessarily the fair value of the option at the date of grant be charged as cost of service. This is the minimum cost that would always arise in the books. Only aspect that you need to remember is that it depends on the, let's say, number of employees expected to continue with the entity, right? Otherwise, any modification would not bring any change on this thing whatsoever. This is a bare minimum change, this is a bare minimum charge that would really come into your books with respect to the share-based payments. Okay? So when the modifications happen, the standard suggests that irrespective of the modification, we need to charge the services at the fair value of the options at grant date. Okay, but then if the modifications are favorable to employees, this may result into an additional cost to the entity over and above this amount. All right, let's try to understand this with the help of an example here. Okay, we'll use some numbers to look into this. What exactly is the standard trying to tell us here? Okay, so say for example, I'm saying that this is a company 500 employees. Okay. $100 options, right? Vesting period is 3 years. Okay. Let's say fair value comes at $15. Is it okay? Right? And then we are saying my assumptions about the numbers as at the end of year 1, I assume that the remaining employees after the vesting period shall be 390. Okay, right? And at this point in time, the share prices have declined, right? Which means that this option's value starts to decline as well. Okay, right? So what the company does, the company says now, as on this date, okay, as on this date at the end of year 1, the fair value of original option is $5, okay, and the dollar price has gone, the value of the share has gone down, so the company reprices the option in favor of the employees. Okay, so the fair value of the original option as of now is $5, but the fair value of revised option comes at $8 now. Okay, that simply means what? It simply means now that the company would need to consider this thing as an additional benefit to the employees for their service, right? Whatever change has happened, it has happened, of course, but then it cannot change the fact that this fair value had considered all possibilities already, right? And accordingly, the cost that is required to be charged should be calculated, right? Should be straightforward now. Is in the year 1, the cost would be 500 employees were there, but it is expected only 390 would remain. It means that 390 into 100 into 15 into 1/3. All right, that would be my first figure, right? Let us say also in the year 2, we expect it is expected that 105 employees will leave eventually. Okay, so that's something we need to kind of remind ourselves on. And then we are saying also that at the end of year 3, only 103 people left, right? So these are the numbers that we need to kind of remember here. So once I have done this calculation for year 1, and this comes to how much? This comes at 390,000 into 5. This comes at 195,000. Is it okay? Right? Now this also is the cost for year 2, but of course the number of employees now changed from 390 to 395. So in year 2, we are saying 395 into 100 into 15 into 2 by 3 minus the cost already charged. Okay, right? But we also have now $395 into 100 into 3 into 1 by 2. All right. So this is something which comes in over and above, right? So this is something which is the additional cost. The $3 is my delta or the change, and the remaining period is of course 1.5, sorry, for 2 years now. So effectively we are saying 395 into 100 into 15 into 2 by 3. This comes as 395, okay, minus 195, this becomes 200,000, and then I have the final figure coming at 259,250. In the year 3, of course, the final calculation would happen on the actual number of people left, which makes it 397. Okay, so this 397 should be a figure for 100 options. Of course, 15 was committed, 3 is additionally committed, so we can say 18 minus the cost charge already, which is 195,000, and 259,250. So when you got this number in front of you, you get the answer as 39700 into 18, that is 714600 minus 195,000 minus 259,250. So this comes to, year 3 cost comes to 260,350. Okay, right? So when you look into this scenario, that's how you would like to do the accounting in the same manner, right? Now this does not make a difference. This does not make a difference at all if in this case the number of options were increased. Okay, so instead of 100 options, if you offer them maybe 120 options, 150 options, 200 options, the same thought process would flow, because there is an incremental benefit offered to employees for remaining 2 years. So accordingly, the accounting would take place in exactly, of course, the same manner. Okay, right? Now, what you need to kind of remind yourself here, what if the terms are modified which are not beneficial to the employees? Okay, so we are saying that although practically it is unlikely to happen that you tell your 500 employees that instead of 100 options, only 20 would be available, or instead of 3 years, you need to serve for 10 years, right? That is unlikely. But having said that, even though it happens, naturally the impact would be seen on the number of employees expected to remain in the organization. So that is how the standard expects the accounting or the cost to be charged into the income statement. Effectively, we are saying that if there is rather a negative change for employees, that impact, any negative impact of modifications is ignored for accounting purposes, right? That's something which is required to be considered as, a change purely arising on, let's say, later scenarios, and that does not impact the accounting for the initial commitment that has been made, for example, to the employees. Is it okay? Right? So that's how you look at the role of modifications, right? There could be thought process around, let's say, what if the options get cancelled, or if there is a early settlement of these options, right? So we would be discussing this part as well as a part of modifications, and how does the accounting work in such cases where the options are cancelled, or let's say a settlement has happened in particular case, right? So we should be discussing that as well as a part of this journey. So that's it from my side on this particular section. Do subscribe to our channel, that is ABC Learning, and have a good day, right? Thank you very much. Take care. Goodbye. Bye.